存款利率正式迈入零时代，钱袋子保卫战。
Deposit interest rates have officially entered the zero era. The battle to protect our wallets has begun, guys. This round of rate cuts can be called deposit assassins. The dream of saving some money and living off the interest is completely shattered. For example, with a fixed deposit of 100,000 yuan for 5 years, the interest earned is only 6,500 yuan, which isn't even enough to buy an iPhone. Chinese banks have recently cut interest rates, prompting many people to complain in videos on social media about the extremely low returns on bank deposits.
这张存单是我在2023年10月份。
This deposit slip was made by me in October 2023 for comparison purposes. The interest rates on mobile banking and at physical bank counters were different, so I specifically opened this deposit, and I still have it. Back then, the 3-year rate was 2.6%. Now, how much has it dropped? It's down to 1.6%. At this pace, next year, no matter the term, deposit rates will likely fall below 1%. Now the demand deposit rate has dropped. What does that mean? On 10,000 yuan in a year is only 5 yuan.
手里有150万，该怎么打理？
If you have 1.5 million yuan, how should you manage it to be both safe and get a high return? When it comes to safety, the first choice is definitely the bank, but small and medium banks have started a new wave of rate cuts, so this iron rice bowl might not be so secure anymore, and if you treat the stock market like an ATM, that's even less possible.
On May 20th, the People's Bank of China authorized the National Interbank Funding Center to announce the May loan prime rates. The LPR for loans over 5 years was set at 3.5%, while the 1-year LPR was 3%, both reduced by 10 basis points from the previous period. On the same day, China's 6 major state-owned banks, ICBC, Bank of China, China Construction Bank, Bank of Communications, Agricultural Bank of China, and Postal Savings Bank of China, along with China Merchants Bank, announced immediate cuts to deposit rates, with the largest reduction reaching 25 basis points. After adjustment, the 1-year fixed deposit rate fell below 1%, ranging between 0.95 and 0.98%. The demand deposit rate dropped to 0.05%, nearing zero interest. On May 21st, 9 joint stock commercial banks, including Ping An Bank, Shanghai Pudong Development Bank, CTBC Bank, and Industrial Bank, followed with rate cuts ranging from 5 to 25 basis points. For example, starting May 21st, Shanghai Pudong Development Bank set the demand deposit rate at 0.05%. Its fixed deposit rates were lowered to 0.7% for 3 months, 0.95% for 6 months, 1.15% for 1 year, and 1.2% for 2 years, cutting each term by 15 basis points. The bank also reduced rates for 3-year fixed deposits to 1.3% and 5-year to 1.35%, each term down 25 basis points. Reuters cited sources saying that China's recent adjustment to the self-regulatory mechanism has lowered the upper limit on bank deposit rates. This indicates regulators are trying to address the rapid deterioration of banks' net interest margins. Sources indicate that banks face significant margin pressure. Historically, every 10 basis point cut in deposit rates reduces bank funding costs by about 5 basis points. Because of fierce competition, commercial banks usually offer their key clients deposit rates at the self-regulatory upper limit. The current large adjustment to this limit will ease pressure on the liability side of banks. Financial experts also state that rate cuts are primarily to save banks. Currently, the gap between deposit and loan rates has shrunk to about 1.4%, while the warning threshold is 1.8%. Without further rate cuts, bank operations could face serious problems. Lower deposit rates can lead to lower loan rates, reducing borrowing costs for enterprises. This could encourage investment. On top of that, with such low deposit returns, consumers may choose to spend rather than save. But some online commentators questioned, with demand deposit rates near zero, will people end up paying to save money? Others expressed doubts about economic recovery under deflation and stagflation conditions. A report by the new media outlet Geopai News noted that the deposit rate cuts directly affect household finances. The 1-year fixed deposit rate falling below 1% means that a 10,000 yuan deposit earns less than 100 yuan annually, forcing depositors who rely on interest income to seek alternative financial products. Actually, this shift toward other financial products has already begun. In recent years, Chinese household bank deposits have increased steadily. From 2008 to 2017, annual deposit growth remained between 4 and 5 trillion yuan. Starting in 2008, deposit growth has accelerated. However, there's a trend of deposits fleeing banks. An article by Zhengzhou Real Estate Watch called this trend a great deposit exodus. Residents are withdrawing deposits, but are not spending on consumption, home purchases, or investing in the real economy. Data from the central bank shows household deposits increased by 9.2 trillion yuan in the first quarter of 2025, but dropped by 1.85 trillion yuan in April alone. This equates to an average withdrawal of 13,000 yuan per person nationwide. Strangely, the withdrawn money did not convert into new consumer goods, down payments for homes, or small and micro enterprise loans. Instead, it entered a financial black hole. This exodus had early warning signs. In April 2024, the Chinese yuan deposits fell by a historic 3.9 trillion yuan in a single month, with household deposits down by 650 billion yuan year on year. The trend intensified in 2025. Central bank data released in April 2025 showed Chinese yuan deposits in March fell to 1.1 trillion yuan, marking the fourth consecutive month of decline. Meanwhile, quarterly financial product holdings surged by 2.3 trillion yuan. Government bond subscriptions rose by 47% year on year, and even money market funds reached single-day purchase limits. In other words, people are withdrawing money from banks to invest in various financial products. People are willing to accept a 1.5% return on wealth management products rather than keep money in the banks with deposit rates below 2%. This reflects a harsh reality of deposit rates shrinking over the past decade. In 2015, a 3-year fixed deposit yielded 4%. Today, the 6 major banks offer at most 2.15%. Interest on a 3-year, 3 million yuan deposit does not cover half a year's rent in Beijing, Shanghai, Guangzhou, or Shenzhen. The article points out 3 hard truths revealed by this shift. First, public anxiety about the future is stronger than fears about inflation. For example, new deposit insurance regulations removed guaranteed payouts above 500,000 yuan, forcing some depositors to split large deposits into multiple family accounts to stay under the limit. Second, asset scarcity is more frightening than a cash shortage. For instance, a white-collar worker living in Beijing, holding 300,000 yuan, did not know where to invest. He ended up buying gold ETFs following trends, and then got trapped when gold prices fell sharply. Third, policy tools are clashing with public skepticism. Rate cuts feel ineffective. For example, a promotion by a Zhengzhou developer offering Tesla cars with home purchases was stopped, strengthening a belief that cash is king. Economists debate the situation fiercely. Some see it as a sign of a balance sheet recession, fearing China might follow Japan's path. Others are optimistic, calling it a financial awakening as funds shift from savings to investment. Yet grassroots voices remain practical. What financial products or government bonds? It's really just fear of old age, illness, and the fact that marriage is unaffordable. With 58% of families holding medical savings over 200,000 yuan and many younger people saving for retirement over 30 years, this deposit exodus reflects a collective loss of security among a generation. This trend of fleeing banks is also spreading on Chinese social media. Many content creators post videos explaining to followers how to better manage money after withdrawing it from banks.
今天也就是2025年的5月20。
To deal with falling interest rates, we should consider 3 aspects. The first is managing your liquid money. Second, long-term planning. Third, making advanced choices.
How exactly should people manage money? The TikToker suggests that for liquid funds, under similarly low-risk conditions, it's better to buy interbank certificate of deposit funds or invest in government bond reverse repos. For long-term planning, bond funds or government bond ETFs are good options, as holding them long-term carries relatively low risk. As for advanced choices, a small portion of risky assets should be included. This could mean index funds, such as broad-based ETFs or dividend ETFs. It's also possible to invest in products not tied to the stock market, like infrastructure funds, which offer higher dividend yields and much lower risk than stocks.
很多人觉得是把钱存在银行呢会比较安全，那这样也
We must save money. Many people think keeping money in the bank is safer, so store it in short-term deposits rather than long-term. Because the interest difference between 3-year and 1-year deposits is only 0.3%, which isn't much, but your money will be tied up for 2 more years. Or you can switch to government bonds or large denomination certificates of deposit, which are better options. Of course, government bonds are harder to buy, so it depends on your approach.
The TikToker points out that even when choosing bank-issued wealth management products, which carry relatively lower risk and offer higher interest rates than deposits, people should understand these products are not the same as deposits. If the bank fails, these products will not be compensated. Besides these methods, the TikToker also advises using one's annual foreign exchange quota to convert some money into US dollars, where interest rates tend to be higher. For long-term idle funds, buying gold is an option, but allocation should stay below 20%. Given the current high volatility in gold prices, it's best not to check the price daily to avoid stress. Bank is meant to be a hedge and should be held long-term. Overall, the TikToker's view aligns with the current depositors' thinking. They're inevitably shifting funds into other financial products. Of course, this is simply his opinion and reflects the widespread discussions online about various wealth management strategies. Everyone should still do their own research. Investment requires caution, as this is people's hard-earned money and deserves serious consideration. But the key issue is that not everyone can add new deposits. With the economy so weak, few people are earning huge sums. Most people's savings come from past reserves. Without income or jobs, these savings become necessary outflows. Facing despair, people must tighten their belts. Data from China's National Bureau of Statistics shows that retail sales of consumer goods grew by only 3.2% year-on-year in the first quarter of 2025. Big-ticket items like automobiles and jewelry continue to shrink. Even average per capita spending during the May Day holiday tourism period dropped 15% compared to last year. The article mentioned by Zhengzhou Real Estate Watch mentioned above highlights a painful shift in consumption patterns. In Shanghai, monthly family education expenses have surpassed 8,000 yuan. In Wuhan, a mother pays 20,000 yuan per semester for her child's programming classes, yet the family's dining out frequency has dropped from once a week to once a month. A Shenzhen tech worker named Xiao Chen said, "It's not that we don't want to spend, but we're afraid to." He calculated that mortgage payments take up 45% of income, tutoring classes 20%, and the rest goes to wealth management and big medical expenses. He says, "Even stocking up on toilet paper on Singles Day feels more practical than going shopping." In the real estate market, although mortgage rates in first-tier cities have fallen to 2.9%, and places like Nanjing and Hefei have introduced strong incentives such as full exemption of deed tax and housing fund loans up to 800,000 yuan, new personal housing loans totaled only 883.2 billion yuan in the first quarter of 2025, less than 9% of total credit. A sales manager at a property in Hangzhou laughed bitterly. He said more people are visiting, but 8 out of 10 ask about prices and then go to the bank to buy large denomination certificates of deposit. The real economy has yet to receive the long-awaited fresh capital. Although loans to enterprises and public institutions surged by 8.66 trillion yuan in the first quarter, a small business owner revealed the truth. He said, "Banks call me every day begging for loans, but my factory orders are down 30% from last year. Why would I borrow just to stockpile raw materials?" Even more bizarre is where the money flows. ICBC loaned 3.1 trillion yuan to technology firms, yet startups in Zhongguanchun still can't raise funds. Construction banks' 3.5 trillion yuan technology loans resulted in semiconductor parks full of empty office buildings. Money seems to be a hot potato inside the financial system, moving from on-balance sheet to off-balance sheet, from wealth management products to the bond market, but refusing to flow into real businesses. Young people living paycheck to paycheck are starting to try saving money. Some say it's not because they have awakened, but because they have no money and feel pessimistic about the future. One commenter said their family's income has reverted 10 years. Since last year, they started avoiding unnecessary purchases on Taobao, stopped ordering takeout, and rarely eat out. Weekends are spent strolling around their neighborhood. They cut all costs, including education, and canceled all of their children's extracurricular classes. They said they used to buy full-size skincare products, but now they only use samples. They barely buy clothes anymore, have given up snacks entirely. They only buy fruits and vegetables, and they canceled their gym membership to jog instead. A user from Guangdong said that by 8 p.m., the parking lots in their community are full as if everyone had returned home for dinner. Before last year, the lots only filled up at around 9 or 10 p.m. A user from Zhejiang said, "I don't throw away the seasoning packet from instant noodles anymore. I cook it once and then add more noodles. One packet can be used 3 times." He predicted Chinese people just can't stop comparing themselves to others. When spending shrinks, they're all competing over who's poorer. Comments flooded in with people sharing how they save money. The post sounded both humorous and somewhat sad. Examples include switching to cheaper mobile plans costing 8 yuan, using a single bar of soap instead of premium body wash, young people rushing to supermarkets during 40% off sales, shopping on discount platforms like Pinduoduo instead of malls. malls, even stopping credit card use. Some eat only 2 meals a day, even licking the lid as they drink yogurt. They save water by not flushing every time they use the bathroom. They sit in McDonald's just to enjoy air conditioning, and they keep using their phones for over 5 years. Behind this frugality is not only a lack of money, but also a poor social security system. This year, Lu Ting, chief China economist at Nomura Securities, said during a discussion on China's economy in 2025 that weak consumption is mainly due to low monthly pensions for 171 million rural elderly people. Over the past decades, agricultural taxes were abolished, and farmers gained health insurance and some pension benefits. Yet, China's low-income groups, especially rural residents, have not fully caught up with the country's economic growth and rising per capita income in terms of social security. Compared to most countries worldwide, China has a large internal gap in its pension system. The top 7% of the population receive an average annual monthly pension of over 6,000 yuan. The middle group, about 38% of retirees in state enterprises, averages just over 2,000 yuan a month. The remaining 55% of urban and rural residents, mainly the 171 million rural elderly, receive an average monthly pension of only 223 yuan. Lu Ting said that for these rural elderly, their income is indeed very low, and their spending ability is very limited. Their situation also reflects the future of China's 300 million migrant workers. Half of China's non-agricultural workforce consists of migrant workers. A small portion may receive pensions of 2,000 to 3,000 yuan in retirement, but the vast majority will get only around 200 yuan, making consumption nearly impossible. This shows the various difficulties currently facing China. People are hesitant to keep their money in banks, but are also scared to spend it. The future looks very bleak, and many hope the situation can improve.